Here's the thing. The stock market is just incredibly fragile. It's so volatile right now. If you notice, every little piece of news makes the market either jump like crazy or drop like crazy. That's not sustainable. How the heck are we supposed to invest in an environment like this? In this video, I'm going to give you multiple scenarios because I work with clients one-on-one and I do private financial coaching where I analyze exactly where their portfolio is, understand their goals, and help them to get to wherever it is that they need to get to. Since I've worked with over 1,000 clients of all levels of net worth, I'm going to dwindle down the top 4 scenarios that I see and that will very much help you wherever you are. The first one will be someone 5 years or so from retirement. The second one will be something like somebody that's currently in retirement and live fully off of your portfolio. The third one is somebody 20 years or more away from retirement. And number 4 would be someone where you have a huge lump sum today and you don't know exactly where or how to invest it. All these scenarios are incredibly important, so let me explain how I would personally do it. For all these, I'm going to suppose that you at least understand my 3-fund portfolio and understand that ETF investing or index investing is definitely the way to go. We aren't talking about adding in some crazy new crypto or some penny stocks that should shoot off to the moon. We're talking about actual investments with actual history that should actually get you to whatever your goal is. My name's Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. So that first one. You're 5 years away from retirement, so you can't afford to lose, but you still have years to gain, so you don't want to go too conservative. This year and next year, we could probably expect some type of a flash crash. We've already seen a couple of them throughout the year, and I think that we might experience not only a flash crash, but also maybe one that's a little bit more sustained, maybe a couple of months worth of drop, sustained low valley, and then eventually we'll come back out of it. There's lots of turbulence and uncertainty coupled with that overvaluation of most of these, especially tech and AI stocks. So what you absolutely don't want to do right now, though, is switch everything up and go hyper conservative in reaction to this possibility of a crash. There's a quote that basically says that more people have lost money in anticipation of a crash, like switching everything up because there might be a crash, than those that kind of just flow with the crash and move through it and understand and set themselves up for something that could happen and just ride through it. For now, being heavily invested in something like the S&P 500 is still the move, along with a safer or less volatile fund like SCHD or something of value, and then a more volatile and higher risk, high reward fund like QQQM for upside. In the dips that do occur in the next 2 years, these are going to be the most important dips of your entire financial life. Do everything you can now to build up that cash amount that you can throw into when we do see a dip of 15% or 20%. That will likely be the biggest gift that'll help you pad up that retirement even more. For me, I'd still be 90 to 100% in equities with the bulk of it in the 3-fund portfolio and maybe a couple individual stocks that you believe in. So if you have money each month right now, the way that I would be investing that is most of that money going into the stock market, most of it dollar cost averaging into great investments, but maybe holding off 10%, 15% of that cash in a high yield savings account or money market that's still getting you that 3.5 to 4%, but it's just sitting there as dry powder so that you can throw it into the next dip. Number 2, you're in retirement and live fully off your portfolio and some Social Security. So you need to be safe more than anything else, but again, you don't want to be so conservative that you lose money to inflation. This scenario is quite different. You're literally living off of your investments. You have no other income other than maybe Social Security coming in. So if a sizable dip or crash happens, this is detrimental to you if you have to pull the money out of the market at that time, because then you absolutely do lose money because you have to sell at a loss. Your priority needs to be to have 2 to 3 years worth of living expenses in a high yield savings or money market account just outside of the stock market. Remember real quick here, if you need something like $80,000 a year to live off of in retirement, and you're receiving about $40,000 a year in Social Security, then what I'm talking about here is your living expenses that you need to come up with is $40,000, not $80,000. So when I say 2 to 3 years, 3 years worth, I'm saying 40,000 times 3 you need $120,000 sitting in a high yield savings account or something of that nature, because you're always going to get that Social Security. Now, as far as your investments should be heavier in the value style of investing, the more safer portion, but not so incredibly conservative that it's all in bonds or something. So I would be looking at something like SCHD or VYM or FDVV, something that's value-based. I'd still want a portion of your money in the S&P 500 or total US stock market to get that appreciation and growth, because technology and AI and a lot of other sectors are for sure gonna grow over these next 5, 10, 15 years. That's gonna happen no matter what. And you want to take part in that, you just don't want to unnecessarily risk the entire portfolio. A solid model could be 2 to 3 years worth of living expenses in a high yield savings account, then of your investable assets, maybe 10% in short-term treasuries like SGOV, 50% in SCHD/VYM, 25% in VU, and 15% in QQQM or SCHG. Now on to number 3, you're 20 years or more from retirement, so you want to take advantage of compound interest and growth more than anything else. You just don't know the best time to get in or to invest more. First and foremost, make sure you have all your high interest debt paid off. If you have something like $10,000 in credit card debt, you absolutely want to pay that off first before investing anything extra. On that credit card debt, you're going to be paying something like 18 to 28% in interest. And in the stock market, you're hoping to get something like 10%, 15% growth. So no matter how you look at it, even if you get a good solid amount like a 15% growth in the stock market, then you're paying 25% in interest, you're still losing money in that scenario. So once you've done that, once you've paid off all of your high interest debt, anything above like 6 or 7% to me is high interest. Once you pay all of that down, then I'd have you start investing, and I would say you want to be investing in both retirement accounts and a brokerage account. Retirement accounts are good because you get some type of tax advantage. Either it's bringing down your taxes now, or later on if you do the Roth, then you're going to have no taxes on the gain. So either way you get a tax advantage there. The only problem is that you can't touch your accounts till 59.5, or at least the growth of your accounts till 59.5. For those of you that possibly want to retire early or you just want to have options, I would just recommend that you have some invested in a brokerage account from an earlier age. You could figure out what you care about most, but maybe you're putting 75% in retirement accounts right now and 25% in a brokerage. That would be very good. Now, as far as what to invest in, we still want a very balanced approach. I know that right now AI and technology is all the rage, and it just seems like this is where the easy money is at, and so I should just invest in that alone only. Well, every time that an industry or group has kind of considered something as easy money, that's the type of person that's lost their entire life net worth. Easy money in 2000 was internet stocks, and then the dot-com bubble came. Easy money in 2006, 2007 was the real estate, and then in 2008 the housing crisis hit. Right now it's AI, and while I think AI will be around forever, just like the internet and just like houses have been, there's a smarter way to invest. And just like I think that you should limit your risk exposure, I also think that you should limit anything that's too incredibly safe or too incredibly conservative at this point in your life. At this point right now, you're in your career, you're making money, that's how you're living. So you can deal with any type of dip or volatility or anything of that nature. So there's really no reason to just sustain your money and put it into bonds or put way too much in cash in a high yield savings account. Having a little bit in that is okay, but the vast majority of this should be something that's not crazy risky only, and definitely not too conservative. I'd go very evenly into my 3-fund portfolio with a third in SCHD, a third in the S&P 500 or total US stock market, and then a third in growth ETFs like SCHG, QQQM, VUG. You could also add riskier ETFs in there too, like VGT or SMH or IBIT, but I'd have them as a smaller percentage of that category. At your age, you can afford a bit more risk, but keep it within reason. Number 4, you received an inheritance or a lump sum recently and want to know when to invest it. This one's more about timing, and since I don't have a crystal ball and literally nobody else does either, you have 2 options in my opinion. Well, actually you have 3, but I want to quickly cross one of those options off the list right away. And that third option would be that you just hold all of your money off to the side and wait for this supposed crash to happen. Like I was saying from before, more people actually lose money by not putting money into the market, by waiting for this eventual big crash to happen. You just can't time the market. It just can't be done. So one of the two options that you could absolutely do is you could take all of that money that you just got in a lump sum and you could just throw it in today. Let's say you did the research and you like my 3-fund portfolio, or maybe you just want to keep it super simple and just put it into the S&P 500 by itself. You could absolutely throw it all in right now. Statistically, time in the market wins, and so that could work out very, very well for you. The one caution I have here, and because I've seen this personally working with so many clients, is that this is going to hit you psychologically and probably emotionally. Because let's just say that you have $100,000 that you can invest, you throw it in today, and 3 weeks down the road, the stock market drops 15%, your money now just went from $100,000 down to $85,000. That's gonna hurt. That's gonna make you say, man, I wish that I didn't invest all of it right then. I wish I had a portion of it to put in now. This article released by Vanguard shows that both lump sum and dollar cost average are great. But here's their summary findings. Our research finds favorable potential outcomes in immediately investing a lump sum versus cost averaging or holding on to cash. So overall and overwhelmingly, in any real investing book that you read that stood the test of time, they're gonna show you that if you just invest at a certain point and you put a lot of money in at that point, that by holding it in the market for a long period of time is going to grow probably at the best rate. But it's not gonna grow exactly from A to B. It's gonna go down, come up, down, up, but then eventually it's going to have been a very good move to just have put that money in 15, 20 years ago. Since I agree with them, but I also know that psychological and emotional health is a real thing, especially in investing, and most people actually pull money out because they see too much of a dip. My favorite option here would be that next option, and that would be to do somewhat of a hybrid investing idea, where we put about half of your lump sum in today, no matter what the price is, even at all-time highs. But then I would take the rest of it and have a calculated time frame to how much I would dollar cost average. So let's just say it is $100,000. If we put $50,000 in today, and then I say over the next 5 months, I'm gonna put another $10,000 in each month, that gets rid of my entire $100,000 over a 5-month period, and I get some of that average based on if the market drops or if it goes up. If it's a bigger amount, or if you want to be a little more conservative, maybe only do $5,000 a month over the next 10 months and get an even better average. It's really up to you and your risk profile and how you want to do this. This video goes over my 3-fund portfolio much, much better, and it actually goes over each percentage of the 3-fund portfolio for you to invest in based on your age, because it does change with age. Or watch this video to keep you going strong in investing that I just made earlier this week.